Bloomberg Audio Studios. Podcasts, radio, news.
Unfortunately, he's been dreading this all week, Richard Clarida, with us now. His work at Columbia University, definitive on fancy economics called dynamic stochastic general equilibrium theory, holding court at the Fed as vice chairman. I'm not going to mince words, and frankly, Professor Clarida, are you still at Columbia?
I am.
You get a piece of chalk out every... See, the problem is Xavier Salih Martin wouldn't allow AI in the class. You'd allow AI in a freshman class to make the kids smarter, right?
I don't teach freshmen anymore, but...
Would you let AI in the class?
Well, not in the classroom, but when I teach, I assume the students are making reference to it, which is why I've actually put a focus on having in-class presentations.
There you go.
There you go.
Little
old-fashioned Socratic dialogue.
I'm going to cut to the chase, Socratic dialogue. You saved Jerome Powell. Folks, I'm not going to mince words about it. It's called a dual-engine leadership model, and it was Clarida as vice chairman and a guy from Wall Street as chairman, and when he came in, you allowed him to relax and grow with your prodigious academic abilities. Does Chairman Warsh need a Clarida?
Well, that'll be his decision. I enjoyed my 4 years, that's for sure. But there are a lot of good people at the Fed, and I think that's a decision he'll make. He's got a very good vice chair right now, Phil Jefferson. But at some point there will be a vice chair vacancy.
Is that something that the committee, when he goes in front of these tough guys in the Hill, they can demand he have a vice chair of the academic skills of you?
Well, it's not clear that that's what would be on their wish list, but possibility, I suppose. I mean, they could request that, certainly.
Kevin Warsh has called for a new accord with the Treasury Department.
Yeah.
What does he mean by that?
Well, this is one of those things where this is very what they call in D.C. very big tent language. It means different things to different people. The one accord that we do know about, which is the one that was struck in 1951 between the Treasury and the Fed, was a signal moment in Fed independence because it got the Fed out of the business of essentially capping Treasury yields. In fact, as I like to teach my students, we all know that World War II ended in 1945, but the Fed didn't get the memo until 1951 because the Truman administration pressured the Fed to keep a cap on rates. The Fed declared independence in the accord. I think now if there is a Treasury-Fed accord, it would not be so much focused on that. It would be focused on, for example, should the Fed hold $2 trillion of mortgage-backed securities? Should the composition of the Fed's portfolio really be tilted toward T-bills and less from holding 10 and 30-year Treasuries? So I think there are a lot of conversations to have. And even during my time on the Fed, there were discussions before the pandemic about rethinking the Fed's portfolio composition. So I think that's entirely appropriate. But I think we're a long way away from any formal accord.
So what do you expect this Federal Reserve to do in calendar year 26?
Well, first we have to get the chair confirmed. And
that's not a foregone conclusion, right?
I think once he has a hearing, he will get confirmed because he's very well qualified. And but it may be a while before he has a hearing. I think it's important to note that the Powell Fed in December, when they released those dots, those famous or infamous dots, the Powell Fed, or at least a majority of the Fed in December, thought at least one rate cut this year would be appropriate. And I think 8 folks thought maybe 2 rate cuts would be appropriate. So I do think that when Warsh gets in, if the economic data play out the way that I and others expect, I think he'll be able to persuade the committee to continue to cut rates down to around 3%.
Okay.
Richard Clarida with us, folks, the former vice chairman of the Fed, hugely visible, does a great job helping us on the Fed Day. The Fed decides. Thrilled he could be in studio with us for you across the nation and around the world. Thank you for your attendance on YouTube. Subscribe to Bloomberg Podcasts. I look at all this. I look at the parlor game, and just what it comes down to is staggering from meeting. When Mr. Warsh joins, do we have a theory of monetary policy, or is it every president and governor for themselves?
Tom, fantastic question, because I do think that based upon what Kevin has said with his very voluminous paper trail over the last 15 years, I think that will be a discussion. I think Kevin has expressed some skepticism for reliance on what he believes are flawed models, too much of a backward-looking approach. What I would point out, at least during my 4 years, is the Powell Fed, and certainly the Clarida vice chair, was not handcuffed to the models, even though I developed many of them.
I give you great credit. Paul, can I editorialize?
Sure, let her
I give you great credit for this. You are the one person who could have said we go for the models.
Well, and in fact, my first speech in October of 2018, I basically made the case that the economy appeared to have stronger growth potential and a potential for lower unemployment than the Fed models thought, and that the Powell Fed should be willing, if the labor market was continuing to blossom and inflation didn't appear, to allow that to happen. In fact, I think I said, monetary policy is not a problem if too many people are working, right? And indeed, the Powell Fed cut rates in 2019 with an unemployment rate at a 50-year low. So I think the Fed has probably been less handcuffed to models than Kevin's remarks might suggest. But I certainly think, based upon that, there will be a discussion of the best way to incorporate modeling into Fed analysis.
What happens to Jay Powell when he does step down from the Fed? Does he stay at the Fed? Does he leave? Typically, they ride off into the sunset, right?
They do. In fact, there's only one example in Fed history of a chair that did not ride off into the sunset, and a very important Fed chair, a gentleman named Marino Eccles. So important, he has a building named after him.
There you go. Okay.
And Eccles was an FDR appointee. And when Harry Truman came in, Harry Truman wanted a different Fed chair. But Eccles stayed on for 4 years as governor, and actually turned out to be a real thorn in Harry Truman's side. But fast forward to Powell. Jay Powell's been asked many times, including at the most recent press conference, what his intentions are when his term as chair is up, and he's really not commented. So there's the possibility he could stay on. I myself think that it's unlikely that he stays on for the remainder of his term, which goes through 2028.
Richard Clarida, with this, so we did a Bloomberg function. It was great. Michael McKee organized it. It was all these worthies in the audience. Yeah. Catherine Mann comes up and gives me a hug, the Queen of Dissent, over at the Bank of England. What's wrong with us being like the Bank of England and they come out like a Supreme Court decision? Oh no, it's a Fed meeting, 5-4, and the chairman voted against the majority. Is that a bad thing?
I don't think it's a bad thing. I think the Bank of England, really beginning under Mervyn King's tenure, actually viewed it as a feature, not a bug, to have close votes, encourage thoughtful dissent. And as I recall, the governor's been on losing side on some votes there. Unusual in Fed history. In fact, to prepare for your show, I went back and looked. St. Louis Fed has a great database on this. And you'd have to go back to 1939, the last time a chair actually lost an FOMC vote, and that was Marino Eccles. But G. William Miller and Paul Volcker lost votes on discount rate adjustments. But again, we're going back 40, 50 years.
Did you hear what he said? Do you prepare for this show?
Oh, of course.
Are you kidding me?
You'd be the only one.
Richard, what's the Fed focusing on now? Is it the labor market? Is it inflation? Where's the balance these days?
They've been pretty consistent for a while that inflation's too high. It's been above target for 5 years. It'll probably be above target this year for 6 years. But the Fed has a dual mandate, and the unemployment rate is basically right now at a point that they think is consistent with a healthy labor market. But they are noticing that payroll employment gains have been very modest. Indeed, when we get the revisions later this week, it actually may show negative payroll gains in the second half of the year. And so I do think that I take them at their word when they say they would not welcome any additional rise in the unemployment rate. And I think they would react to that. But so long as the economy sort of churns along as people expect, I think they are trying to balance that against their concerns about elevated inflation.
Paul Sweeney with Richard Clarida. Right now, can I ask, can we go nerd right now?
Yeah, absolutely.
On a Monday, a freezing Monday. Okay, did you recruit Woodford to Columbia? Was that your triumph?
I was not chair when Mike was recruited, but I certainly was enthusiastic and worked hard on getting him to Columbia,
Right.
which was a huge appointment for Columbia,
Yeah.
now 22 years ago.
I told you, Michael Woodford, folks, it's a 1,000-page book. Everybody owns it. Martin Feldstein once said, Tom, no one's ever read it cover to cover. Clarida has.
I have. Yeah.
But the bottom line, and I'm bringing this up, folks, because we had an Ezra Prasad the other day from Cornell with this wonderful, important book out.
Doom Loop.
The Doom Loop. A really important book.
Yeah.
And the bottom line is we assume Woodford-like Euler equations, they come down to a point of stability. And within a system, there's stability. The end result is stability. And Professor Prasad is saying, no, it's not. They're going to go out on the x-axis and be unstable. Discuss.
Well, okay. I think at a 30,000-foot level in 30 seconds, all macro models, or almost all macro models, really are best thought of as approximations, typically linear in a neighborhood of where you want to be. And the real world can be a lot messier and very nonlinear, a term that I know pops up on this show. And I think as I've just beginning to read his book, what he's been highlighting is we could be in a prolonged period of very nonlinear market and economic development.
And geopolitical developments as well. So if you're halfway through the book, he sold the movie rights.
Yeah, exactly.
DiCaprio's playing. I mean, it's a gloomy book. It's shockingly gloomy.
Yeah. I've not worked through it, but certainly a must read for me. So I'll wait till I finish it before I weigh in on that.
Fair.
Hey, Richard, we're 13 months into this whole tariff thing. I'm going to look back on it and say, boy, this was nothing. It didn't seem to be that big of an issue. And that's not what I heard early on.
Yeah.
I heard a lot of folks saying, boy, this is going to be inflationary and so on and so forth. We just haven't seen it. So with a little bit of hindsight, what's happened?
So let me reinforce what you said. When we get the data for 2025, it may show GDP growth the same as it was in 2024, maybe down a tenth. It will likely show inflation unchanged from 2024. And so a future historian may well say what you just said, Paul, which is, what was the big deal? GDP growth didn't move, inflation didn't move. I think a couple of things. One is that the ultimate tariffs put in place were a lot lower than the Liberation Day levels, and as Besson has emphasized, that was part of the negotiating strategy. Secondly, there's a saying in baseball, sometimes you'd rather be lucky than good. I think the other thing that happened is whatever headwind there might have been from tariffs, counterfactually, was offset by the buoyant CapEx spending, especially by the tech companies, and the fact that the stock market is very optimistic on this story. So that generates a wealth effect and an investment effect. And then thirdly, U.S. companies absorbed more of the tariff hit in somewhat reduced margins. And in the aggregate, they did have that room. Profit margins have been very healthy, and they didn't pass it through to the consumer. And again, of course, we have the IEEPA decision the Supreme Court is about to release, and that may further lead to lower adjustments. Put it this way, I think if you calculate the tariff revenue we're collecting divided by imports, it's coming in at about 10%, and Liberation Day was like 35%. So that's sort of the order of magnitude.
I got 8 other questions. I got to squeeze us in to be responsible. Orszag and Posen creating a firestorm with an idea of resilient higher rates or even driving higher rates, somewhat due to the surprise of higher wages, writing this up at the Peterson Institute. Do you at PIMCO worry about price down, yield up?
Well, we get paid to worry about it. What we do observe, at least in the Treasury market, is the fact, which is really since the last Fed rate hike, which was 2.5 years ago, 10-year Treasury yields have been in a pretty tight range. 4 3/4 at the high end, 3 3/4 at the low end. Now that you also need to note that underlying real rates, which we can see from the inflation index bond market, are much higher than they were in 2019. And so we're going to have a steeper yield curve than we did pre-pandemic, which is a good thing. I think we're going to probably have somewhat elevated volatility relative to the decade before the pandemic, in which rate volatility was suppressed through zero or negative. Remember, at one point, I think in Europe, there was like $18 trillion of negative yielding sovereign debt. So we do pay attention to it, but we think a lot of the repricing that needed to happen because of the fiscal outlook has basically already happened and is in the price.
I'm begging, when you get through the doom loop, when I get through the doom loop, I would be honored to have you and Prasad in the same studio together.
Done.
That would be like a service to a lot of people thinking about this. His public service to the nation at the Federal Reserve System, Richard Clarida, he is Global Economic Advisor at PIMCO.